Institute and TELUS Institute webinar on a new report, ESG Investing by College and University Endowments. Today, we'll go through brief introductions. We'll talk about why this research was conducted, do a comprehensive review of the research, and then take your questions. Our speakers today are John Lekumnick, Executive Director of the IRRC Institute, and Joshua Humphreys, the Principal Investigator and the lead author on the TELUS Institute study. With that, I'll turn it over to John Lekumnick to give an overview of the IRRC Institute and why this research was commissioned. John?
Sure. Thank you, Kelly. Thank you all for attending. Just a very brief note about what the IRRC Institute is. We are an independent, not-for-profit research think tank. We fund and disseminate information about corporate responsibility and the informational needs of investors. We tend to think of that in 4 areas, although we prefer when we do not silo them: the traditional ESG and also capital markets, because we understand that if you start from an investor viewpoint, the capital markets clearly matter. All of our research is available free of charge at www.irrcinstitute.org. Some of the more recent ones you can note below. And it is also available at SSRN, the Social Science Research Net. Next slide, please, Kelly. We funded this research for a couple of reasons. First off, college endowments control more than $400 billion. Now, while that is a material amount of money, we understand it is not the trillions that are in retirement savings, but it is still a material amount of money. As importantly, however, college endowments historically are thought leaders. They were among the first to bring ESG, or as it was then called SRI, socially responsible investing, to the forefront of institutional investors, largely around the anti-apartheid movement in the 70s and 80s. They have also been thought leaders when it comes to asset allocation, the so-called endowment model of investing, which focuses on alternative asset classes, illiquid asset classes, etc., most notably as publicized by David Swenson at Yale. At the same time, my background is as an institutional investor. I used to run a fairly large pension plan. And I spend much of the year going and meeting with institutional investors and saying, what do you want to know more about? What don't you understand? And I rarely, if ever, run into college and university endowment officers. And there's a reason for that, as the report shows, and as I'm sure Josh will mention. They are curiously absent from investor networks. None of them have signed the Principles for Responsible Investment. Globally, that has more than 900 institutional investors and asset owners, and I'll make the distinction between a mutual fund company as a manager and a pension fund or an endowment as an owner. And PRI has more than 30 trillion in assets under management, and yet no U.S. university or endowment has signed. One is a member of the Council of Institutional Investors, which is the largest group of U.S. asset owners with more than $3 trillion in assets under management. Finally, if you are curious about college endowments and you try to go on the web and find out about them, you will find there's little transparency overall. So we decided to commission this study to understand what they were doing, given their historical leading role, and yet their curious absence from all the networks today. With that, I will turn it over to Josh Humphreys, who will give you a detailed presentation of the findings. Josh?
Thanks very much, John, and thanks everyone for being on this webinar today. We're delighted to present our principal findings of this new report on ESG investing by college and university endowments in the United States, social responsibility, sustainability, and stakeholder relations. Just before I begin, I wanted to say just a couple words about the TELUS Institute. We're a Boston-based nonprofit interdisciplinary think tank founded in the mid-70s by a group of concerned scientists who were particularly focused on problems of energy and environmental resource management at the time of the founding. And since that time, over the last 3.5 decades, our research program has expanded in scope to encompass sustainability issues in the broadest sense at literally every geographic scale of analysis one can imagine. Our main research today focuses on issues of corporate responsibility and redesign, impact investing, fairness in finance, ecology and social equity, and some of our recent publications that my team in particular has published can be found here at the bottom of the slide, often dealing with questions of capital markets, sustainability, and higher education, its role in the capital markets. Next slide, please. I'd also like to just give acknowledgement to a lot of the people who made this research study happen. First and foremost, obviously the IRC Institute for generously funding the work and commissioning the study. I also want to acknowledge my team members here at the Institute. I had the pleasure to write the study with 3 co-authors, Christy Electris, Ann Solomon, Katie Ferrara, and we were supported by 2 research analysts and assistants, Bryant Mason and Jamie Silverstein. We also were very fortunate to have an expert advisory panel of external specialists in the endowment space. And these are listed here: Dan Apfel, the Executive Director of Responsible Endowments Coalition; Peter Connie Brown, an academic fellow at the Rock Center for Corporate Governance at Stanford University; Mark Orlovsky, the Executive Director of Sustainable Endowments Institute; and Luther Reagan, the CEO of the Global Impact Investing Network, and a lecturer at Harvard Kennedy School, as well as a former investment officer himself at the FB Heron Foundation. And then finally, we, as you'll see in just a moment, basically the novelty of our study is that we have brought together in one place a large aggregation of multiple data sets on endowments. And here are our principal data sources that we list here from the Association for the Advancement of Sustainability in Higher Education, Common Fund Institute, and NACUBO, the National Association of College and University Business Officers, Sierra Magazine, Sustainable Endowments Institute, and the US SIF Foundation. Next slide, please. Before I get into the data, though, I just want to advertise our key findings at the top level. John has already alluded to some of them. What we have found in the endowment space in this study is that the investment practices that touch upon environmental, social, and governance issues, and I'm going to abbreviate it as ESG throughout the balance of my talk here, the principal activities in ESG investing by endowments remains largely confined to single-issue, exclusionary, negative screening of public equity portfolios. Tobacco, sin stocks, and selected targeted divestment from the Sudan are really principal activities in this space. Overall, we found that the endowment community exhibits a very weak understanding of the leading ESG investing strategies, trends, nomenclature, opportunities that exist. We found that the endowment community, by and large, as a whole, tends to have a very anachronistic understanding of the ESG investing space, as if they were trapped in the 90s. And as John mentioned, and we actually arrived at a kind of conclusion in this study, is that a principal reason for this lack of understanding is precisely the absence of endowments from leading investor networks where ESG practices are discussed in a very routine manner. We do find within endowments, in addition to negative screening, a considerable focus on proxy voting, and there is a strong contingent of very well-endowed schools that have innovative governance structures that involve multi-stakeholder input on the advisement on proxy voting related to ESG issues. But precisely because of the endowment model of investing that really places a high premium on reallocation into alternative asset classes, such as hedge funds and private equity, venture capital, commodities, real estate, and other real assets, proxy voting in listed equities has become less important in the endowment model's application. Nevertheless, schools tend to place the majority of their emphasis within the ESG space on precisely these proxy voting recommendations. John also has alluded to the general lack of transparency in endowment investing, and we'll get into that in more detail. When we do see activity, though, we have found the key drivers behind the activities in the ESG investing space by endowments is driven principally by faith-based traditions at schools that that are religious in character, at least historically, and through activism. A lot of the ESG investing activities that schools embrace is quite frankly not through any kind of sanguine acknowledgement of the pertinence of ESG issues in risk analysis or investment opportunities, but rather simply in a kind of responsive mode to the demands of stakeholders. And indeed, because of that very common dynamic that we encountered time and time again as we studied individual cases and looked at the data at the higher level, we have developed an interpretation that we advanced in this paper, a novel interpretation, that stakeholder relations are really key to understanding ESG investing activity and uptake in the endowment space. And we think this really distinguishes endowments from other institutional investors, principally foundations, philanthropic foundations, with which, in fact, endowments are often twinned in the capital markets community. Finance investment officers, especially on the sell side, tend to associate foundations and endowments as a kind of community. If it is, it's one that's really segregated, we think, in a lot of different ways. And one implication of our findings is that there needs to be a real decoupling of foundations from philanthropic endowments when it comes to ESG issues. So next slide, please. So as for the data, I mentioned the sources initially, and what we did in aggregating these various third-party data sources is developed a really novel data set that has a sample size of about 460 colleges across the wide range of sizes, with combined assets of over 320 billion out of the approximate $400 billion that endowments maintain. So we're getting about 80% of the space in asset-weighted terms in this data set, which notionally has a lot of overlap. But at the same time, by merging the data sets together, we think we get really broad and unique coverage in a way that we haven't seen before. Next slide, please. So what the data provide us is a platform for conducting 3 axes of analysis. And this is how we organize the structure of the report, which I strongly encourage everybody on the call to take a look at if you haven't had the opportunity to read it cover to cover, because I'm only going to be able to give a bird's eye view of the findings today, and it is, you know, a roughly 50-page paper. But the data does provide us with purchase on several issues. The first of which really has to do with the incorporation of ESG factors and criteria into the investment analysis and decision-making process by endowments. We find activity that not only is related to the negative screening to which I alluded earlier, but also some proactive investment in ESG issues, principally in environmental investing, community development finance, and microfinance in particular. Secondly, we also have a series of data points around active ownership activities ranging from proxy voting, to which I alluded earlier, but also more direct and active kinds of involvement in shareholder advocacy, such as shareholder resolution filing and co-filing on ESG issues, as well as direct and indirect dialogue and engagement with companies and management over ESG issues of concern. And then the third and final axis of our analysis has to do with the transparency and governance of ESG investing, and we pay particular attention to the role of students in these processes by looking at the role of students in these multi-stakeholder committees on investor responsibility, as well as increasing numbers of student-run funds. And we also evaluate the data that we see related to transparency. So let's begin with the first axis, related to ESG factor incorporation. And what I like to describe the mainline trend here within the endowment space as is from explosion to erosion. And what I mean by that is if you look at some of the larger asset-weighted data that we'll present in just a few moments, about a half decade ago, it seemed like endowments really jumped ahead in the whole SRI and ESG space because, frankly, they took the lead in the Sudan divestment campaign. And again, this wasn't out of self-interest. It's because of student activism and stakeholder demands for doing it. But endowments really did lead what became a tidal wave that pensions very closely followed, often by legislative mandate. So in asset-weighted terms, it seemed that endowments really were contributing a lot to the kind of assets under management that were subject to different SRI criteria. But when you look over the last 3 or 4 years, especially since the financial crisis, within the data that you see in this table, there is, in fact, in just pure numerical terms, a very steady, slow erosion of schools actually actively incorporating ESG issues into their investment processes. And this is data drawn from the NACUBO Common Fund study of endowments, looked at historically over the last 3 reports. And as you see, you've basically got about a fifth of the endowment space that NACUBO tracks, and NACUBO and Common Fund have the most comprehensive data set. They do not make school-specific data available, but at the aggregate level, about a fifth of endowments are reporting some kind of SRI or ESG criteria incorporation going on. But that's declined steadily, and we see it from 21% to 18% of their sample size, and in numerical terms, that means about 30 schools have no longer reported that they, in fact, incorporate ESG issues into their process. Next slide, please. This gives a disaggregation of that same NACUBO Common Fund study information and data. Again, pure counts of schools that are reporting specific ESG issues. Interesting, NACUBO has recently changed and modernized its approach to the ESG investing space, and no longer will you be able to track this kind of disaggregated issue-specific data. I think that's too bad. But nevertheless, from the 2010 report, we were able to see that tobacco screening really is the predominant mode in which schools are involved in the ESG space, confirming the top level finding I mentioned earlier of single screening being the leading trend. And then you see a whole range of other specific issues, geopolitical location specific, that would include Sudan divestment, as well as some other country specific, human rights oriented divestment or exclusions, and then a range of sin stock screening around alcohol, abortion, gambling, pornography. Suddenly, from that cluster, you go on down the line, and it may be striking to see how the environment comes out fairly weak in just numerical counts in the NACUBO study. Less than 25 schools report any kind of environmental ESG factor incorporation. Next slide, please. And if you asset weight those criteria, not based on the NACUBO data, but based on our own efforts at verifying the application of those criteria, you get a very different picture. When you ask the question, how much of endowment portfolios are actually subject to these kinds of criteria, rather than just tallying up the number of schools that incorporate them. And here, Sudan becomes the most important, affecting more than $150 billion in endowment portfolio assets, highlighting how big schools, which really drove the Sudan divestment process at the first, it was Harvard that made the first announcement of a targeted divestment from the Sudan. This also raises some fundamental questions now that the situation in Darfur has really ebbed in its severity, whether this really has any meaning. And I think we'll find out later in this year when US SIF Foundation comes out with its biennial trends report, with which, full disclosure, our team is very actively involved in the research behind. That said, tobacco, again, in both numerical terms and asset-weighted terms, remains very, very prominent. But beyond Sudan tobacco, we just have a precipitous drop-off in assets, as you see. Human rights without a country-specific focus touches about $15 billion in assets that we can see, and then you can go on down the line. Next slide, please. Again, just to reiterate, so in asset-weighted terms, the kinds of, and numerical terms, the kind of leading issues that we see in negative screening tends to be around targeted Sudan divestment, tobacco policies, human rights policies, faith-based sin stock screening. All of these things tend to focus in the listed equities asset class. Often, schools only apply these policies to stocks that they directly hold in separately managed accounts. And this is a real challenge, as we'll see, for transparency later on. This came out in the, again, to use Harvard as the example. Harvard, announced a policy of divesting from the Sudan in targeted ways by focusing on specific Chinese companies. Yet 2 years after the policy had been implemented, it was discovered by investigative reportage by the student newspaper, the Harvard Crimson, that in fact, Harvard had not divested from ETFs and other index funds that were in those same markets. So in fact, they had indirect exposure to the exact same equities that they had divested, raising fundamental questions of the actual meaning of the policy. And this goes back to the nature of intermediation in the capital markets as funds, commingled funds become instruments and vehicles of choice for endowments. Next slide, please. We do, though, see proactive investment and environmentally sustainable investing is one place in which we see that, even if it doesn't touch tons of assets. But one finding that we discovered is that the terminology that's used behind environmentally sustainable investing is extremely inconsistent on the part of both the survey providers and the schools themselves. And this led to the discovery of extremely divergent data, which you see just in these first 3 bullet points. With the Nukubo Common Fund subset of schools that said that they incorporate some kind of ESG or SRI into their portfolio, we saw about a third of that subset reporting some kind of environmental criteria. This is less than 25 schools, as I mentioned earlier. The ASHE data, the ASHE STARS data, roughly correlate to the Nukubo data, yet in the Sustainable Endowments Institute Green Report Card survey data, more than half of all of the respondents to that survey, literally over 100 different schools, report incorporating some kind of environmentally sustainable investing. And when we tried to actually independently verify these claims that were self-reported by the endowments, we immediately hit the transparency obstacles that we've already alluded to at the beginning here. So it's really hard to know in asset-weighted terms as well as in numerical terms what's really going on in this environmentally sustainable investing space by endowments. That said, we did highlight a few cases in the paper that we think are worth note and that are indicative of trend in interesting ways. It appears from what we could see within existing limits of disclosure and transparency that Yale is a real leader in the sustainable investing space. They've committed at least $1.4 billion, if not more, in alternative asset classes like timberland, clean tech, private equity, venture capital, direct investments in renewable energy. And $1.4 billion across those kinds of vehicles is a good chunk of a $19 billion portfolio. So, we are talking about at least a 7% allocation if these commitment numbers are correct. Another interesting initiative is the Sustainable Investments Initiative, in which 2 colleges are involved, Middlebury and Dickinson colleges. This is a program that's actually run by Investor LLC, a boutique outsourced CIO investment firm that a group of endowments and philanthropic foundations use, basically investing their money through this consulting firm run by the former CIO of the University of Virginia's endowment, Alice Handy. And it was really the clients of Investor that brought this initiative and said that they wanted to actually commit more of their assets to sustainable investments. The leader behind this initiative, though, was not the colleges, interestingly enough. It was really the Rockefeller Brothers Fund, a philanthropic foundation, which has committed the substantial portion of the assets to the program. It's about a $40 to $50 million program. So for RBF, that's I believe it's a 5 to 10% initial commitment, ramping up to 15% and perhaps beyond if it proves successful as they hope. Whereas for Middlebury and Dickinson, they've committed combined less than $10 million to the initiative, which is, at best about 1% of their endowments. So it's, let's just say it's a very modest commitment or allocation to sustainable investments. They began in listed equities, and apparently they've made commitments to private equity, but at least publicly, they're not disclosing the investment vehicles that they're choosing So again, limits of transparency hit us in actually understanding this interesting demonstration. Another trend that we found, and this is thanks to the research that Sustainable Endowments Institute has been doing as part of their Green Billion Dollar Challenge, is the use of green revolving loan funds. These are innovative financing mechanisms that help colleges to actually finance energy efficiency improvements on their own campuses. And the way in which the funds work is that the energy savings actually go into the ROI calculations. And SEI has done some very interesting case studies on some of these schools and the kinds of returns on investment that they've seen from them. Most of these actually come out of operating funds, not from endowment funds, so we excluded them from our analysis. But two schools stood out as actually funding these initiatives out of their endowment. The California Institute of Technology was one of those, and Weber State in Utah is the other. Next slide, please. The other area of proactive investing where we saw a lot of endowment activity, at least reported in the data, was in community development finance, both domestically and abroad, internationally through international microfinance institutions and vehicles of different sorts. But again, we encountered very quickly very confused use of terminology, and the data again diverged in very dramatic ways. We saw 48 schools reporting to Sustainable Endowments Institute that they were investing part of their endowment funds into community development loan funds or other community development financial institutions. These are certified and regulated institutions by the U.S. Department of Treasury. These institutions must have a targeted mission on providing financial financing and financial services to low and moderate income communities, that is the financially underserved in the U.S. Yet when we looked at the ASHE data, we found only 9 schools reporting these, and in those 9 cases, many of them proved to be unverifiable. And to put a fine point on it, there would be cases like the University of Louisville in Kentucky where they were reporting that they were investing in CDFIs, community development financial institutions, when in fact what they were doing was investing in very conventional private equity and venture capital that had a regional focus in the South or in Kentucky, but in fact were not targeted at low and moderate income communities in the way that community development venture capital does and has done in a state like Kentucky for decades. And this seemed to be a general pattern. Repeatedly, schools were reporting involvement in community investing, quote unquote, that were not meeting the definitions of the survey providers, nor were they meeting the definitions that the community development finance community tends to use. So there's clearly a lot of confusion about what a community investment is. We found that many university community partnerships, quote unquote, were being counted as community investments. These range from volunteer service programs and philanthropic giving and local grants to actual investments that sometimes would come out of endowment, but the nature of the social and community benefits were completely unclear to us. So we frankly excluded them from our analysis. And when it came down to it, although some schools had made investments in CDFIs, community development credit unions, banks, venture capital funds, or loan funds, the fact of the matter is that we couldn't identify any out of endowment. The only community investments that we could identify being made from endowment were microfinance. That is to say, no community investments were done domestically out of endowment, at least not that schools would be willing to verify transparently. But we're able to find 3 cases of microfinance being done from endowment, and they're listed here. Goshen College in Indiana, a Mennonite school, has invested in MicroVest, a very small commitment of about $100,000. Seattle University has made over the last half-decade about $1 million commitment to various funds by Global Partnerships, a Seattle-based microfinance organization. And then most ambitiously, the Omidyar Tufts Microfinance Fund at Tufts University has now become a $115 million experiment across 10 microfinance investing vehicles. Interestingly, this was designed through donor restriction by Pierre Omidyar, one of the eBay founders. And it was designed explicitly as an educational experiment, a demonstration project to show the viability of microfinance for institutional investing. Yet despite this educational mission, the school provides no information about the commitments that they've made to specific microfinance vehicles. We were able to find and track down information on a little more than half of those vehicles just through our own investigative research, including using publicly available documents from places like Germany, which actually have to list their LPs and shareholders. So we find this kind of curious thing where Tufts actually has to be disclosed as a shareholder in these microfinance vehicles in other jurisdictions in Europe, but won't disclose them to stakeholders and authorities here in the U.S. It's kind of an interesting paradox, again, in transparency. Let's move on then to the next slide. The second axis of analysis we have is around active ownership. Very quickly, I mentioned proxy voting being really preeminent. These numbers from SEI highlight that. The first two rows show that the vast majority of schools in the SEI survey set either lack the ability to vote proxies because all their fundings, all their holdings are in commingled funds, or they simply delegate the casting of proxy voting and the handling of proxy voting to their investment managers. So the vast majority, both in number and in assets, basically handle ESG issues in proxy voting in that way. That is to say, they don't handle it, they delegate it. And so there's no real clear sense of how ESG issues are being handled. We do see at the bottom of the chart in asset-weighted terms about 44 schools had reported to SEI that they had committees that included student representatives that advise or make recommendations about ESG proxy voting. When we actually scrubbed that data, we found that many schools, about a fourth of those were actually just reporting that they had investment committees that were dealing with proxy voting. They didn't actually have multi-stakeholder constituencies. Students weren't involved in the decision-making. But those were a lot of the large endowments. Next slide, please. More actively, we did find a small handful of schools that are actually filing or co-filing, principally co-filing shareholder resolutions on ESG issues. Here's a list that we were able to pull over the last half decade. Some of the successes that have come out of universities getting involved in the process are interesting. Bard College's shareholder resolution, which was a student-initiated action at McDonald's, asking McDonald's to disclose its use of pesticides in its potato supply chain. McDonald's is the biggest purchaser of potatoes in the United States, and that resolution was proved to be very successful in its dialogue with the company. Similarly, Loyola University Chicago filed at JP Morgan about its financing of mountaintop removal coal mining at places like Massey Energy. And again, some interesting policy changes occurred from the engagement that happened through the resolution and proxy process by Loyola University. A lot of these schools, if you'll notice, are religious, and they work with the Interfaith Center on Corporate Responsibility to get these things done commonly and co-file with other ICCR members. And we do see support by groups like the Responsible Endowments Coalition and the Investor Environmental Health Network to provide valuable resources to this limited number of schools that do get involved more actively in the proxy process by filing resolutions. Next slide, please. Now, we mentioned dialogue being fairly limited, but we did find a very small handful of schools that are engaging in investor networks and also engaging directly with with companies with which they have some concerns by doing letter writing or directly dialoguing with companies. We found about 13 schools that actually use direct dialogue. Others use networks, the Conflict Risk Network, which is the organization that basically is the legacy organization, the original Sudan Divestment Task Force after several mergers of various nonprofits concerned with genocide. About a half a dozen endowments have disclosed their participation in the Conflict Risk Network, which includes other institutional investors. Apparently more schools participate, but they do not disclose their membership in the network for some reason. So we weren't really able to tally it fully. As John mentioned, only one endowment, the University of Connecticut, is a member of the Council of Institutional Investors. Only 3 are formal members of ICCR. Only 2 are members of the Investor Network on Climate Risk, the project of Ceres that includes asset owners and asset managers with roughly $10 trillion in combined assets under management. And then at the same time, we see just an absolute absence of endowment participation in some of the other leading investor networks where ESG issues are routinely discussed, whether it's the Carbon Disclosure Project, the Global Impact Investing Network, the IEHN, the UNPRI, or US SIF, the Forum for Sustainable and Responsible Investment. Next slide, please. I think we skipped one really quickly there. Maybe we'll go back one. Yeah, so another area, this is the third axis of our analysis, actually around governance and transparency of ESG investing. We looked at two institutions in particular, committees on investor responsibility. As I mentioned earlier, we scrubbed the self-reported data and were able to identify 35 schools, not the 44 reported to SEI, that actually involve multi-stakeholders and include student feedback. The primary focus of these committees, though, really remains proxy voting. Some are able to get into ESG policy and investment decision-making, but very few do. Most of their time is just completely absorbed by the proxy voting season and making recommendations on proxy voting that may not even necessarily be followed by the fiduciaries who cast the votes. We also see an interesting trend of smaller student-run funds that are emerging. Many of these actually are portions of the endowment, small portions of endowment funds that students are getting discretion to manage and incorporate ESG issues. 18 of the 25 we were able to confirm were actively investing now. And of them, we were able to find asset information for 11 of them. Combined, they run about $24 million of funds. Here are 3 cases of the largest and kind of most active that we saw, but there's a large table and discussion in the full report that you can see. The UC Berkeley Business School at Haas has an SRI fund with a little over $1 million in assets that's been invested for a while, where students are making direct investments using ESG research in their analysis. The University of Dayton Flyer Investments is the largest fund that we identified, actually with $13 million, more than half of the combined pool that we identified for the whole space. Their focus is really exclusively on governance. They're also a signatory to the PRI, one of the only colleges that has participated in the PRI. It doesn't affect the University of Dayton's broader endowment or any of the commitments that they've made, but it's interesting to see Flyer Investments getting actively involved in the space. And then finally, Notre Dame has a $5 million student-run fund that takes SRI seriously into account. Now, in terms of transparency, interesting findings. This is SEI data on investment information and how it's made available to various constituencies. As you see, trustees and senior administrators and select individuals, often with close to investment decision-making power, get wide access to information, yet other constituencies very quickly lose access to information. Three-quarters of schools in the SEI sample do give access to the entire school community about asset allocation, which is fairly limited in its information about exactly what kinds of investments are being made by the schools. In terms of the actual managers and investment vehicles that schools use, far fewer schools make this kind of information available, even to their own on-campus stakeholders. Less than 40% make such information available to students and staff and others directly involved in the community or alumni. And roughly a quarter of schools provide this kind of information about their actual holdings, their managers or their funds, to the general public. And I think it's worth underscoring here that this quarter is predominated by public schools who are subject to open records laws, even though private schools, although private, are still tax exempt, and their investments are being generously subsidized by taxpayers at both state and federal levels because investment gains are not taxed. So it's interesting how little disclosure is being made to the general public by endowments about their endowment holdings. Next slide. Indeed, final slide on transparency. And again, this is SEI data from the Green Report Card, which grades schools at various levels. And one of the grades is about endowment transparency, as well as an overall grade that's provided to schools about the full range of sustainability initiatives going on their campuses. And you see simply here a distribution of the overall grades contrasted to the endowment transparency grades. And what you see is a clustering of endowment transparency at the, let us say, below average and failing level. C's and D's really appear to be the average grades, whereas you see a kind of a more normal distribution of overall grades clustered more around the B level in their sustainability initiatives. The takeaway from this, quite simply, is that endowments or colleges are doing much more when it comes to sustainability in their campus operations, greening their campuses and the like, than they are when it comes to providing open information about how their endowments are invested. And without more endowment transparency, stakeholders are going to have a difficult time holding endowments accountable for the degree to which they're embracing the environmental, social, and governance issues that increasing numbers of investors are acknowledging provide very material ways to understand risk and investment opportunity. So with that, I'm going to conclude and be glad to take any questions.
Thanks, Josh. This is Kelly. I just wanted to run through quickly how we're going to take questions. If everyone notices, on the right-hand side of your screen, there's a question box. If you want to type a question in there, I can read it aloud to John and Josh, and they can answer the question. Alternatively, you can type in, please unmute my phone line, and I'd be happy to unmute your phone line, and you can ask the question that way as well. So again, just type a question into that question box. Just one other thing before we start the Q&A. The report and this PowerPoint will all be posted on www.irrcinstitute.org. The report is already up, and the PowerPoint and a rebroadcast audio file of this webinar will be posted hopefully today and definitely by tomorrow. So that will be available, and if anyone has an urgent need for it, just give me a buzz and I can email you the MP3 file or the PowerPoint file. So with that, we will move on to questions, and the first question we have is, given the widespread adoption of the endowment model of investing with such heavy allocation to alternatives, what can endowments do in alternative classes beyond the work in listed equities?
I suppose I'll take that. This is Josh. So I think basically this question gets at a big misconception that we encountered repeatedly in the course of our study, and that is that endowment officers and consultants often told us that the degree to which endowments have embraced the endowment model of investing has really limited their options in the ESG investing space. And frankly, I was surprised to hear that time and time again, precisely because there's so much activity going on in alternatives. Traditionally, SRI and ESG investing has perhaps been dominated by products available in listed equities across kind of geographies and sub-asset classes. But you know, the fact of the matter is, if you're a signatory to the PRI, you'll know that there are working groups in just about every alternative asset class you can think of, work streams related to hedge funds, to real assets, to commodities, private equity, and venture capital. I mentioned the case of Yale. Its activity actually is almost exclusively in alternative asset classes like timberland, renewable energy direct investments, and other kinds of sustainable investments in private equity and venture capital. The Sustainable Investments Initiative I referred to that Investor is running for its clients is split, bifurcated between listed equities at a global level and private equity and direct investments. So there clearly are opportunities across asset classes. SRI is not an asset class specific discipline or practice. Instead, it is something that can be incorporated across asset classes. And I think, you know, if anybody has any questions about that, I'd be glad to follow up with you separately. There are lots of resources available, not only from the PRI, but also from the Initiative for Responsible Investing at Harvard University, which has done a lot of asset class specific research.
Thanks, Josh. Our next question, the analysis seems to be looking at stock exclusion, negative screening, Did the study look at the use of ESG factors in stock selection, positive screening?
Yeah, I mean, but only within the limited disclosure that we have. So how robustly they did this was really impossible to really get a firm purchase on. I highlighted the two main areas where there appeared to be proactive investing going on. It is around sustainability, environmental issues, ranging from clean tech. We didn't see a whole lot of best in class kind of analysis. We didn't see what sometimes is described as third generation ESG, integration of ESG issues alongside traditional financial analysis. Very few schools provided any example of that. We every now and then see some benchmarking of portfolios against some of the mainstream ESG indices like the Dow Jones Sustainability Index, but it was really unclear to what extent that actually affected the stock selection. Indeed, it seemed like at times that schools were simply turning to whatever they could find in order to fill out the surveys, to be honest, because of a lot of the misunderstanding around the nomenclature.
Thank you. Our next question. Those who are moving ahead, like Yale, what is driving that? Students, alumni, anything else?
That's a good question. And I can't get into the mind of the Yale Investments Office, so I won't dare to. It's obviously run by David Swinson, who's a pioneer in radical diversification into inefficient capital markets. I think there has been long-standing multi-stakeholder engagement around the Yale Endowment to encourage it to invest in ways that take seriously not only ESG issues because of their materiality, but also because of the ethical issues. Perhaps it's worth reminding the audience that it was at Yale that James Tobin and others had the famous seminar on ethical investment in the late 60s and early 70s that led to the book of the same title, Ethical Investment, in which ultimately the university decided to create one of the first committees on investor responsibility, which continues to work today. The focus is still on proxy voting, but it has recently been modernized because of student activism. The Responsible Endowments Project at Yale has been a very important player in this, and Yale is one of those schools that's also created a student-run fund. And full disclosure, I'm a member of the advisory board of that student-run fund, small student-run fund at Dwight Hall. So I do think students have played an important role, but ultimately I do think that if the Yale Investments Office is making commitments of the size that it is to sustainable investments, it's because it sees a risk-return proposition that fits its models. Obviously what's going on is, I would argue is reflective of the larger trend that we see in the endowments community, that you cannot understand the activities of the Yale Investments Office without understanding the multi-stakeholder dynamics, the dynamics of stakeholder relations that are so key.
Our next question, in looking at the 18% of respondents reporting ESG, is there anything unique about the demographics or geographical location of the school or student bodies?
Well, what's hard about that data is that it's the NACUBO Common Fund data, so they don't actually disclose the constituents of that subset. So it's difficult to draw those kinds of trends. When you look at the disaggregation by assets, you can make inferences. And when we cross-reference that to our own controlled data set, a couple of patterns emerged. Again, I think I mentioned it. Private faith-based institutions are doing a lot of the SINSTOC screening. To be honest, a lot of those are very small schools, but there are very large endowments that are worth mentioning, such as the University of Notre Dame, which has roughly a $7 to $8 billion endowment, I believe, by last tally. It may have been updated in fiscal year 2011. Our data was lagging slightly as we did the aggregation. But the University of Notre Dame, run by a very prominent CIO, Scott Malpass, incorporates SRI guidelines according to the U.S. Conference of Catholic Bishops. It's very common for Catholic schools and Jesuit schools to get involved in the shareholder process, as we saw, but they tended to be the smaller institutions that were using active ownership as a strategy. Then we saw a range. Both public and private schools are embracing these limited SRI activities. And I think the handful of schools that we spotlighted are suggestive. They range from, public schools in places like Utah and California to private schools in the Northeast. So they do range widely, including plenty of schools in the Midwest as well.
Our next question, are any campuses accounting for the carbon/climate impact of their investments?
Not really.
Next question, did you study whether the motivation for ESG investing was coming from donors, trustees, finance committees, administration, or student body and faculty?
Not in a controlled way, but obviously we were constantly asking precisely those kinds of questions, which is how we developed our thesis about stakeholder relations being so crucial to understanding endowments. And I think it really varies from school to school, and the dynamics can differ widely from school to school. The Tufts experiment obviously is a donor restriction, and if you actually read the report, the full discussion of the Tufts situation, you'll highlight that transparency has been a very big problem. At that school, students have been pushing and pushing, and ultimately, if a donor's got $100 million to gift to a school, then dynamics can pretty quickly change. But I would say that overall, the phenomenon that we found, the dynamic was one of responding to claims and demands on the part of donors, alumni, students, and to a lesser extent from staff and faculty and local communities. That's really the dynamic. Rarely do you see trustees driving this, although I will mention the case of microfinance again. For some reason, microfinance is something that's been very attractive to donors and trustees, though the commitment by Seattle University really, I think, grew as much from the investment committee and the board as from students. Students have been very active at a school like Seattle University in part due to support from the Responsible Endowments Coalition. But I think the microfinance commitment, which happened more than a half decade ago, really was because board members already saw the value of microfinance in their private investments and thought that the school could support a local microfinance institution as well. So it's really quite diverse, the drivers.
Our next question, were you able to look at performance of ESG investments by endowments?
No, there's no transparency. And we discussed this related to the green revolving loan funds, and one of our conclusions in the paper itself is that there needs to be greater transparency around performance, as there has begun to be around the green revolving loan funds. SEI has done really great research about ROI when schools are willing to disclose it, but we need more case studies. We were getting this from other segments of the capital markets, in listed equities, and from other institutional investors who are willing to disclose their holdings. We need more information. Endowments really have to be more forthcoming about the performance of these things.
The next question, what are some additional barriers that need to be broken down to advance ESG-related practices?
Before Josh answers that, Josh, before you answer it, and it's fine, you go ahead and answer it. I just want to make one thing clear. The IRC Institute is not an advocate for or against ESG investing. We want to make the information available to investors so that they can make an informed judgment as to whether or not to integrate ESG, do single stock screening, whatever. And what we found interesting in the report, as Josh said, is how much terminological confusion there is, how much opaqueness there is. All of those are barriers to making an informed, good decision. And so while the question is, implicit in the question is an assumption that we want to push for more of that, and that may be true for most of the people on this call, I want to make it clear from the IRC viewpoint that what we want to do is we want to remove barriers to thoughtful consideration. So with that, Josh, go ahead and answer it from the, what are the barriers, but I just wanted to make it clear what the IRC Institute's position is.
Yeah, no, I appreciate that clarification. I think you've touched upon two of the main ones, and it is around transparency of information. When you're investing in the ESG space based on rumor and hearsay, it's hard to make informed decisions. And I think that that's a real problem, especially when you're trapped in a mindset from the 1990s about SRI. So I do think that information is an important barrier. John also at the very outset alluded to the absence of schools from these investor networks. If they just join on, they'll get a chance to actually meet in the flesh other sustainable and responsible investors that are doing this and don't seem to have too much complex about it in different ways, depending on their mission and their concerns, their fiduciary duty, all kinds of different things. But it would be good for them to be more well informed, and so that's an easy obstacle to overcome. I think many people on this call may have different views about this, and we don't really get into it, but I think repeatedly as we had discussions in the course of this, almost year-long research now is that the fiduciaries really bear a large blame, I would say, for this, and that may be too strong a word from IRRC's point of view. Let's just stick with obstacles and barriers. The fiduciaries ultimately have decisions, and we've done research on all kinds of issues related to problems with boards these days, that they've become unduly influenced by very conventional alternative asset managers. This is quantifiable, and you guys can take a look at some of our other research on trustee conflicts of interest and things like that at very prominent schools. To get a sense of that. And also, investment consultants. They're the real gatekeepers that provide cover to trustees to make these kinds of decisions. Now that's changed, and we do discuss, the case of groups like Investure and Cambridge Associates, which has, which is the largest investment consulting firm in the endowment space that's created a dedicated mission-related investing unit to its credit. But my sense is that very few endowments turn to that MRI unit at Cambridge Associates. Instead, it's business as usual. So I do think that the fiduciaries themselves are the problems. The boards are really operating under very conventional kinds of understandings of what SRI means. And if they spent more time at these gatherings that people like John Lekomnik go to, then perhaps they might have a different understanding of that.
Our next question, if I understand correctly, only 276 of the 464 schools were gradable re-endowment transparency. Can you speak a little further about the non-gradable institutions? Was your team able to scrub further? Is there any differentiating factors between the non-gradable institutions?
Yeah, this is a great question. It's obviously a perceptive data miner there in the audience. It's a really a question for SEI, for Sustainable Endowments Institute, but we did ask them the same question, and they did not grade schools that basically said that they really had no clear control over their proxy voting one way or the other. And also very small schools, and there's some kind of asset threshold where they didn't grade. They didn't feel that it was fair to grade because their allocations to listed equities were so small that it didn't seem appropriate. But I would really probably turn that question, kind of punt it to SEI, because we didn't actually do that survey and make those kinds of decisions. But I think overall the answer is that a lot of schools are in commingled funds and are small. Or have small allocations to listed equities, much smaller than they may have had in the past. They just don't have directly held equities that they're making proxy votes directly on.
Okay, we have a couple more questions, and we're at the top of the hour at 3 o'clock when this call was scheduled to end. I can take another question, and if there's more questions, we can follow up with you all individually, because I know some folks on the call have a hard stop. Our next question, the colleges and university endowments are disappointing in their incorporation of ESG factors into their investing. Have other sectors, for example, pension funds, foundations, faith-based funds, done a better job?
Yeah, I mean, I think so, basically. And Kelly, you might want to flip to the last slide just so people have our contact information. If you want to follow up, I'd be happy to follow up offline. There's my email and phone number here at the Institute. But yeah, absolutely. That's exactly what led us to highlight the distinction between endowments and the rest of the institutional investor community. Philanthropic foundations have really embraced mission investing. I referred to the Cambridge Associates initiative around MRI. That was led by philanthropic foundation clients, and it's no coincidence that most of their clients involved in that program are philanthropic foundations, not the college endowments. Pension funds, I mean, you can look at CalPERS, which is committed to incorporating ESG across its entire, $200+ billion portfolio now as part of its investment decision-making process, investment analysis and decision-making process. Even hospitals, some of the Catholic hospitals are leaders in the proxy process. They've created venture capital and private equity funds dedicated around their mission to do healthcare investing that's consonant with their faith-based concerns. It just seems like almost everywhere you turn, there's real experimentation going on. And obviously there's some experimentation, very limited, that we describe here, but it's at the margins in the endowment space, in contrast to the $400 billion that they control.
Terrific. Well, we're at the top of the hour, so we're going to conclude the call. There are several questions we didn't get to. For those of you who didn't get to ask your questions, I'm going to download them and get them to Josh and to John, and we will follow up with you on those questions, either an email or give you a call if we have access to your phone number. Thanks, everyone, for being on the call. Again, the report is posted on ircinstitute.org, and I believe it's also on the TELUS site. You can also find it on ssrn.com. This PowerPoint and then a replay of this webinar should be posted later today or by tomorrow at the latest. If you have any questions in the meantime, our contact information is posted on this last slide. Please feel free to contact us at any time. We thank you very much for your attention and hope everyone has a wonderful afternoon. Thank you.
Thank you very much.